Hi there, good morning and good afternoon to those joining in Australia and the UK. Thank you very much for making your time, giving us your time today to come and join us for this webinar, for joining the team here representing BDH Sterling to you today as we present to you a great session outlining unlocking your UK pension potential in Australia. During this session, we will share information and considerations around UK pension types. We'll look into what the options are around the possibility of transferring these UK pensions and the pros and cons of looking into that. We'll also look into QROPS, which may be an anagram some of you are familiar with already. And then we will look at moving on to some Q&A towards the back end of today's webinar. So just to begin with, and before we move into the webinar itself and the presentation's content today, a bit of housekeeping. We are just going to start with a general information warning. This presentation today is based on Australian and UK legislation as at today, which is the 2nd of April, thankfully not April Fool's Day. So it is all can be taken seriously and is a general information, everything that we'll be going through today. It is not tailored advice specific to your situation. So before acting on any of the information contained in today's session, we would encourage you to seek tailored financial advice specific to your needs before you do take that action. So without further ado, I'll provide you a bit more of an introduction into the team here today. So first of all, you've got myself. My name is Daniel Ash-Wentworth. As you can see there, I am a financial planner here at BDH Sterling. I work primarily with our retail client base regarding their UK and Australian financial planning needs, and I will be the facilitator in today's session and assist with the Q&A at the end of today's webinar. A little bit of background about myself. You can probably tell I'm originally from the UK. I now live in Perth, WA, in Australia. I've been with BDH Sterling for 7.5 years and working in the UK pension advice and financial planning industry for 10 years to date. I am qualified in the UK and Australia to provide financial advice and also hold the certificate in pension transfer advice in the UK. And also with me today, I have my colleague Nick Bond, who is one of our senior financial planners. Nick has over 15 years experience in this financial advice industry and particularly working with UK pension transfers. He has a graduate diploma here in Australia like myself and is also qualified to provide financial advice in the UK and similarly also has the certificate in pension transfer advice. So hopefully it fills you with a bit of confidence that you are dealing with the correct people today and there's a fair bit of experience there that we can cover off hopefully when it comes to the questions later on. In terms of what we'll be running through today and the agenda that we'll be looking at, we'll be taking you through the types of UK pensions and why it may be worthwhile to consider transferring those particular types of pensions. We'll be looking into QROPS and what that means, what is a qualifying recognised overseas pension scheme and what we need to be mindful of there. We'll then go into more information around the transfer process, what it takes to transfer across and why advice is important to be undertaken as part of or beginning that process. We'll then finally move on to BDH Sterling and how we can assist you in delivering that advice and implementing any potential transfers or advice that we deliver to you. And finally, we'll then take any questions that you guys may have for ourselves today. And before we move into the presentation, my final bit of housekeeping would be if you do have any questions as we go through today's webinar, please place them into the Q&A box within the toolbar. Please do not place them into the chat, otherwise they may be missed. And if they go into the Q&A section, we can then work our way through those as we reach the end of the webinar, and we'll endeavour to answer as many of those as possible within the time limits we've got on today's webinar. So without further ado, we will now move into section 1 and the types of pensions and why a transfer could be considered.
Thanks, Dan, and welcome everybody, and thank you for joining us. So what types of company pensions are there? We have defined contribution schemes. So DCs, money purchase, you may be familiar with those terminologies. These are contributions you as the members and, excuse me, potentially your employers. And the value of that fund will be determined on the investment within, and that will change on a frequent basis. Typical names will be personal pensions, SIPs, and group personal pensions. Defined benefit or final salary scheme, as some of you may know them as, are a bit different. They don't have a fund value per se. They will have a pension income that you'll be entitled to. And it's based on how many years you worked for that employer, and what your final salary or average salary was during that time. And typically, when you request a transfer value or a cash equivalent transfer value, CETV, that value will have a 3-month expiry date. The types of pensions that can be transferred, so some can't, but these ones can. Company UK pensions, defined benefit schemes can. Company defined contribution schemes can. SIPs and personal pensions. Funded public sector defined benefit schemes such as the local government or LGPS, as some of you may know it as, and a CUROPS fund. Some of you may have a CUROPS fund in another jurisdiction that can be transferred, and unlikely, but you never know, some of you might have a QNUPS, a qualifying non-UK pension scheme. All of those types of pensions can be transferred to Australia. So what can't be transferred? The UK state pension. So that's your national insurance contributions, however many years you worked in the UK, and paid into the state pension. That cannot be transferred as a lump sum. You will simply receive the income when you reach state pension age. Government unfunded pension schemes. So typical ones, NHS, Army, Police, Fire Service, they're all unfunded, and you can no longer transfer those as of 2015. Some funds may be in the pension protection fund. Typically, defined benefit schemes can be. If they were underfunded and running into trouble, the government has set up the pension protection fund to make sure that they're safe and secure for the future. But once they're in there, you can't move them out. And any annuities that you might have purchased with your pension provider, once they're in payment, they cannot be transferred out. So in terms of the QROPS, we'll go into this in a bit more detail a bit later on in the presentation, but just touching on it, there's only 2 QROPS options in Australia for you. One is a self-managed super fund, SMSF, or the other is a retail fund that anyone over the age of 55 can join. As well as the scheme registration, QROPS trustees also must make sure that the fund reports for 10 years from the date of transfer. So there's reporting events that trigger these reporting requirements, and that lasts for 10 years. And the benefits must be that you receive in a QROPS fund must be similar to those that you would have from a UK pension fund. And you also must comply with the member payment provision period, but we'll come on to the QROPS detail in a few more slides' time. So why transferring your UK pension may not be suitable? Look, it's not right for everyone, but it can be quite favourable for a number of people. But why may it not be suitable? For example, with a defined benefit scheme, the Financial Conduct Authority in the UK, the governing body, their starting point with a defined benefit scheme is that it shouldn't be a transfer, it should be a no. And you then have to build the case as to why it might become a yes based on individual circumstances, and depending on what the value of the pension income is versus the transfer value. It's not always cost effective, so for lower balances, this is can be an expensive procedure. There's tax to pay as well when the fund arrives in Australia in certain circumstances. So that may not be the right thing to do with some smaller balances. Your current UK scheme might be giving you a great level of growth. There might be some guaranteed rates of return, which may be difficult to match or mirror in your Australian super fund. There can be early exit penalties from some schemes in the UK. These are quite rare, but there can be. So if the penalty is quite high, then it may not be sensible to move it. And also, look, with a defined benefit scheme, you'll be taking on investment risk if you come out. Some people may not like to take on this and would rather keep it with the scheme. Sorry, move on to the next slide. Sorry, it jumped one. Bear with me. Why consider transferring? So one of the important things is the currency control. I'm just checking if I missed a slide. Apologies, it jumped ahead of me. Okay, no, we're in the right spot. Sorry about that. Yeah, why consider transferring? The currency can have a great effect on how much income you receive. As you can see from the graph on the screen, the exchange rate moves all the time. It fluctuates a lot over time. I've seen the exchange rate be at $1.45, so a pound buys $1.45, up to a maximum of a pound buying $2.22, and that was in the space of about 3 or 4 years. So if you've got a pension in the UK and you're going to be drawing down from it, there will be long-term currency fluctuations. So by moving it over to Australia, you can eradicate this because you can buy the dollars when you bring the money over. Estate planning. Look, there are some implications on the UK pension. If you pass away post age 75, the beneficiary receiving that will be taxed, and also probably more importantly, particularly for those of you that may have large pension funds in the UK or still have other assets in the UK, in the autumn budget in the UK, it's been proposed that the pension funds will be added to the IHT net. So for some people, potentially they will be hit with a 40%, or their estate will be hit with a 40% inheritance tax charge, and this is due to come in April 2027. Tax treatment. So in drawing down from an Australian super fund, some of you might be aware that you can access that completely tax-free. So you can move your UK pension fund over, draw it out from an Australian super fund and access that tax-free. However, there is tax to pay on the growth of the fund, but only the growth from your date of arrival to when the funds are transferred. So the tax rate is a lot lower than paying it at marginal tax rate for most people. So that is quite a significant benefit. It will also enable you to consolidate your pensions. Typically, people have got 2 or 3 UK pensions dotted around in the UK, and sometimes there'll be different fee structures for each of those pension schemes. Sometimes you might not be invested in the right funds. They may have been great when you first started, but if you haven't looked at it for a number of years, they may not be the most appropriate. So consolidating them all is normally quite a big bonus. So what is the tax on drawing it down from the UK? The income you draw from the UK pension will be taxed in Australia at your marginal tax rates. So whatever other income you have outside of super, if you've got a rental property or shares or you're still working, all of that income will be added to your tax return and then taxed at your marginal rate of tax in Australia. In the UK, you're able to access a tax-free lump sum of 25% when you begin drawing your pension fund. This is tax-free in the UK, but in Australia, it's not tax-free. The ATO don't recognise that, and there are tax implications on drawing that 25% lump sum from the UK. And potentially also, if you take the wrong type of lump sum, that lump sum can be taxable both in the UK and in Australia. So outside of the 25%, you can choose to take other forms of lump sums. If it's done incorrectly, there could be tax on both ends. So the tax on the transfer to Australia, as I touched on earlier, the growth of the fund from when you arrived in Australia to when the fund is transferred to a QROP superannuation, but the remaining balance is completely transferred tax-free, no tax implications whatsoever. And as I said, down the line, you'll access that from superannuation completely tax-free in retirement. So transfer options for someone aged 55, aged under 55. You can't physically transfer the fund until you reach that age. And point to note, that age is increasing to 57 as of April 2028. So some people will unfortunately be caught up in that age change and may not be able to transfer for a couple more years. But if you're under 55, what are your options? If you can do nothing, leave it all where it is, or you can consolidate into the UK into a self-invested personal pension or a private pension and leave it there. Often there's the option to convert into Australian dollars and invest in Australian dollars. So you're preparing yourself for that future transfer when you hit the right age. Or yeah, as I said, you can leave it where it is until you hit the age and do nothing with it. So what is a SIP? It's a personal pension, but it's similar to an SMSF. For those of you that know what an SMSF is, a self-managed super fund, it just gives you a lot more flexibility. So I mentioned before the opportunity to be able to buy dollars and invest in dollars. That's quite useful given the fluctuation in the currency throughout time. It can be good to buy those dollars when the exchange rate is looking favourable, or for that matter, when you think the exchange rate might be looking against you. You can lock it in, take that future currency risk out, and then you can invest those dollars in an Australian dollar-denominated portfolio. So it's the closest you can get to having a super fund, but it will be obviously still domiciled in the UK. So I've covered most of that now, but yes, dominated in GBP or AUD, invested in GBP or AUD, 100% of that SIP will pass to your beneficiaries if you pass away under the age of 75. So that can pass on tax-free. And you can have as much input into the investment of the pension as you like, or as little. So if with a SIP, you could be a self-directed person and choose what you want to invest in, or for the majority of people, they'll use an advisor to make those investment decisions for them, make sure the fund continues to be going in the right direction and is invested appropriately in line with one's attitude to risk and goals and objectives. So case study for someone under 55, John, who is 53, has 2 company pension schemes in the UK totaling $350,000, which he would like to transfer to Australia. So his options are consolidate the pensions to a SIP or a personal pension. The SIP will give more flexibility because you can buy the dollars. Typically, there's not many personal pensions in the UK where you can buy those dollars and invest in dollars. So investor funds, once John's made the decision whether he wants to buy the dollars or keep it in pounds, and then leave it in there in the UK for a couple of years till he reaches age 55, at which point he can then set up the QROP scheme in Australia, and then he can commence the transfer strategy in line with the non-concessional caps. So the non-concessional caps are $120,000 per annum, and you can use 3 years worth in one go. So what are the options at 55 and over? So once you're 55, or if you're already 55, sorry, you can immediately begin the process of transferring to an Australian QROP scheme. So you've got to get that set up, and then you can, once your QROP scheme is set up, you can begin transferring those across, or again, leave it in the UK if that is the most appropriate thing for you. So moving on to section 2, detail now about QROPs. But people still are familiar with the QROPs acronyms. It's actually a ROPS now, but it's Qualifying Recognised Overseas Pension Scheme. These were introduced in April 2006 with the idea of enabling people to move their UK pension funds to different jurisdictions a bit easier than it had been in the past. So yeah, that came in nearly 20 odd years ago now. And for a QROPS fund to be allowed, it's got to meet certain requirements set by HMRC. For example, for the Australian schemes, members can't be under the age of 55. And QROPS is a great option for those who've left the UK permanently, not looking to retire in the UK, but are going to be retiring abroad, and have built up their retirement savings whilst working in the UK. So legislation changes. This is quite important. There are changes fairly regularly, and often they can be detrimental to one's transfer. So it's important to transfer when you can, because there are future legislation potential risks. So yeah, in 2015, the government, UK government, stopped allowing NHS, police, fire service individuals from transferring out. They also then introduced the pension age test, which prior to 2015, you could be any age and move your UK pension fund over to Australia. But as of April 2015, the pension age test came in and then restricted to those who are only over the age of 55. As a result, every Australian QROP scheme was removed from the QROPs list. So your typical Australian Super Fund, Host Plus, or Australian Super, or ART, they would have been able to accept it back in 2015, but they were all removed from that QROPs list and no longer able to accept overseas transfers. Yeah, it's a big year in 15. The FCA also brought in the requirement for advice for defined benefit pensions. If the transfer value was over £30,000, one must take advice from an advisor with the relevant permissions to give advice on defined benefit transfers. In 2017, prior to 2017, you used to be able to move your transfer, your fund to any jurisdiction, whether you resided there or not. In 2017, that was changed, so you must live in the jurisdiction that you're transferring to. If you don't, then there's a 25% tax charge applied. Contribution limits in July were reduced by the Australian government. Prior to July 1st, 2017, used to be able to do 540, and then it got lowered right down. So there are changes on the Australian side sometimes, as well as on the UK side. Benefits of a QROP scheme. So your UK pension will now be in the country you're living in, and be in that country's pension regime. You can have the fund in GBP or AUD, depending on what your needs and future goals are. 100% of your pension passes to your dependent if you pass away. So rather than having that age requirement, or sorry, age limit in there over the age of 75, in Australia, 100% you can pass to your spouse of your fund without any tax liability whatsoever. The tax treatment, as I touched on earlier, drawing your income from an Australian super fund is most cases more tax advantageous, because you won't be getting taxed on that drawdown from an Australian super fund. And also your Australian super and your UK pension can be consolidated if you want to have one fund rather than have a QROPS fund and a couple of Australian super funds, for example. You can merge all that together and roll them all together into one, which makes the ongoing administration easier. It potentially can help with the investment side of things to make sure everything's invested in line with your attitude to risk, rather than having to change 2 or 3 as your circumstances adjust. So what are the QROPS responsibilities? So I mentioned them earlier. The QROPS fund must report back to HMRC for 10 years from the date of the transfer. So in some instances, there can be multiple transfers because of the non-concessional limit of $360,000. So it's 10 years from the date of that last transfer. And yeah, the benefits must be broadly in line with those from a UK scheme. So, for example, in a UK pension fund, you can't own residential property, but in an Australian self-managed super fund, you can. But you couldn't do that in a self-managed super fund if you've got a UK pension money in there, if you've transferred that over. So it's got to remain in line with that. There's also a member payment provision period, which is at least 5 years. So, for example, in that period of time, you would have to keep the fund in the QROPS super. You couldn't move it to a non-QROPS within that 5-year time period. Doesn't mean you can't draw on it, which some people get confused about. But if you've met condition of release in Australia and you're met the preservation rules, even if you're within that 5-year period, you can still draw on it. But you can't roll it out of that QROPS fund to a non-QROPS fund within that member payment provision period. So on to the transfer process. So the transfer process will be to get in touch with us for a free meeting whereby we can assess whether or not we can help you and whether or not it will be worth your while for us to assist. After that initial meeting, we would then take you on, if you wanted to engage us, take you on board to provide you with a pension transfer analysis report, and also we can look at your overall financial planning needs, not just the pension piece. That is a big part of the jigsaw puzzle, but we can also look at your overall financial planning needs and work that together with the pension transfer report. Then we will get the report together. We will present it to you. We will make our formal recommendations in there of what we think is in your best interest, and then from there you can decide whether or not you wish to proceed. If you do wish to proceed with the advice, you can also then move to the next stage, which will be for us to manage the transfer process, getting the money out of the existing schemes over to the Australian fund, or in some cases out of the existing schemes into the SIP prior to the transfer to Australia. So now we are on to a case study for someone over 55. So Janet is 60. She has a defined benefit scheme with a transfer value of $740,000. She would like to move her fund to Australia, and she would like to access some funds to repay her mortgage. So Janet will need to consolidate this into a UK pension fund, personal pension fund first from the defined benefit scheme, because she is over the non-concessional limit of $360,000, which is 3 years worth of non-concessional contributions. once we've got that underway, we can also at the same time set up the QROP scheme in Australia for Janet. Once that's set up, it's ready to receive the UK funds, and then we will commence that transfer from the SIP or the personal pension in line with the non-concessional contribution cap limits. As I mentioned, $360,000, which can go every 3 years. So if you used your non-concessional limit this year of 120,000, for example, you'd have to wait until July for it to reset, and then in July you've got 3 years worth of non-concessionals that you can use. So your transfer can take place in July of that 360. Then Janet will assume that she's be to cease employment at age 60, and then she can withdraw money immediately from her Australian QROPS fund to help her repay that mortgage, and then invest the remaining funds that are left after making that withdrawal for the mortgage. So why should you seek advice before you make any decisions? As I mentioned earlier, there are often changes that can affect individuals. Normally, it's to one's detriment. Occasionally, it can be to one's advantage. So it's imperative to understand what those rules are before you make a mistake, which, look, unfortunately, we do come across where people do things unknowingly and get themselves into problems which sometimes can be unsolvable, but the majority of the time that they can be solved. But look, it's just better to get the advice before trying to do something yourself and making mistakes. If you do make a mistake, albeit this would be rare for it to happen, but penalties can apply of up to 55% of the fund value for non-compliant QROPS transfers. And also initially confirming if that UK pension is transferable. Some people don't understand what can and can't go. So yeah, it's important to understand if yours is actually allowed to go in line with legislation and whether it's going to be viable or not. So that's me done. I will pass back over to Daniel.
Thank you, Nick. Apologies all if my voice sounds like it's going. I don't know what's happened today, but clearly got a croaky voice. But I'll just go through with you a bit more about BDH Sterling and who we are as a firm. So to those of you who are may not familiar with us, we are a chartered firm in the UK. So obviously holding that additional certification there, we are advised or dual licensed advisors in both the UK and Australia with permissions to provide pension transfer advice, which is extremely important for you as a client to ensure that you're covered under the advice that's being delivered to you both and also you're receiving advice from people that are familiar with all of the pitfalls and the complications that you need to be mindful of with such a complicated process. We have worked and reviewed a number of UK defined benefit pension schemes. So what I would say as well, it's extremely important for you when engaging for this advice, you are working with a firm who's more than familiar with defined benefit schemes and the intricacies because of the guaranteed benefits that those schemes offer. It's extremely important that you are taking everything into consideration and making an informed decision before you elect to either transfer or retain that pension scheme. We've provided advice in-house for both the UK and Australia, do so through our offices across both countries. So that's a key, I guess, niche and USP that we can offer here at BDH Sterling. And we are able to provide advice on other holistic matters such as Australian Super. We have a sister company, BDH Tax, that can provide personal tax advice and all-round retirement planning that we can offer through our UK and Australian offices that we currently hold. So if you do want to chat to ourselves, what I would suggest is you are best making an inquiry through our email address there, which is inquiries@bdhsterling.com. If you are wanting to engage for financial planning or UK pension transfer advice, send us an email to that email address, and please outline what advice you're looking for, what your age is, what your asset position is. So we've got that going into the first conversation with yourselves, and we can then approach that first conversation with a bit more of a broader discussion around your current situation, and then develop that into a more holistic retirement plan from there, if you do elect to engage for that personalised advice journey from that point onwards. So finally, we'll move on to the question and answer session to complete today's webinar. So we have had a number of questions come into the Q&A chat. So thank you very much for anyone who shared a question with us. I'll start and work through those chronologically in terms of when they've come in. So firstly, we have here, someone's curious to know, they've had 17 years of funding into the state pension, and 22 to go. Do I get anything if you've left the UK? So I think what you mean by that is you've had 17 years worth of national insurance contributions. You believe you're not at the full 35-year entitlement. So are you eligible for any UK state pension at all? You will be eligible for a partial UK state pension, as you have more than 10 years worth of national insurance contributions. It is important to make sure you are confirming with HMRC that you've got 10 years of full contributions at the minimum, and they'll be able to give you an indication of what that partial entitlement is based upon your years of national insurance contributions to date. The next question is, we are 52. Are we able to transfer any UK pension across to Australia yet? Unfortunately, the answer is no. You do need to be 55 at this point in time. And as we've alerted earlier, it is increasing to 57 in 2028, which I have noted another person has asked the question of their turning 55 in 2028, and what date will the age increase to 57? That will be as of the 6th of April 2028. So if you're 55 before that date, then at the moment in time, under current legislation, you should be fine to still explore a transfer. If you do not turn 55 until after April 2028, then unfortunately you might have 2 years further to wait based on the current proposed legislation around the age changes there. Nick, a question for yourself. Are you able to transfer a contracted out of SERPS pension?
Yeah, thanks, Dan. Yeah, you can. That's no issue. It's looking at it simplistically. It's a personal pension. There can sometimes be some guarantees underlying, but in most instances, you should be able to transfer out of that. The SERPS pension for sure. Yeah.
Another question here is, can you set up everything ready to go and then wait for a good exchange rate to actually pull the trigger, or does timescale make this too hard? So the interesting thing is we can actually look at facilitating a transfer in AUD or GBP. So I wouldn't say that the currency exchange rate is going to be a reason to hold off transferring. If we do recommend a transfer and you do wish to go ahead with that recommendation, we can look at your circumstances and what you're targeting and look to facilitate that in your currency of preference, depending upon the exchange rate at that point in time. So the next question I'll pass to yourself, Nick. Assuming you have a large pension pot over the lifetime allowance limit, is there a UK exit tax of 25% over and above this limit? And how is this limit reduced if you've already taken your UK tax-free lump sum?
The short answer is yes, and the long answer is probably far too long to go into, because it's going to be based on a number of different scenarios and circumstances of how much you've used of your former lifetime allowance. But look, we're well across it. We completely understand what you can and can't do, and can certainly provide advice, tailored advice on that area.
And the next question, someone's asking about a pension scheme they commenced back in 2002. I won't state the specific name because, again, we can't give personalised advice on this. but we can comment on the scenario. So this person has contributed to it for a number of years, and they've received an annual statement confirming the valuation of that pension scheme. Can they transfer this sum without paying income tax in Australia? Because it is a long-term investment which has not been added to since they've been here in Australia. So as Nick mentioned, if you are bringing the capital amount of that pension across to Australia, you do not pay income tax on that. You pay that tax based on the applicable fund earnings on the capital value from your date of arrival to the point in which the transfer takes place. On the flip side, if you retain that pension in the UK and you withdrew that as an income, then you would pay tax as part of your worldwide taxable income here in Australia. So therefore, it would be subject to your income tax. I would say in your position, it's worthwhile contacting ourselves to go into the specifics a bit more and your personal situation, and potentially look at engaging us for advice if you did want to go into that situation in a bit more depth. Nick, what does the 9th of March 2017, a lovely date that I know you're familiar with, where the 25% tax charge on QRUPs was introduced, where a member does not reside in the same country as the QRUPs? Does a Jersey-based pension scheme for a UK resident apply?
So the 25% tax charge is applied if you transferred, and I'll use New Zealand as an example because it's close to Australia. But if you had a UK pension fund and it was moved to New Zealand rather than Australia, then the 25% tax charge would apply there. If it's a Jersey-based scheme, it depends if it's a QRUPS or not, or whether it's a pension, personal pension. There was schemes in Jersey that were QRUPS. They're no longer, it's no longer a QRUPS jurisdiction. But if it were an international pension, for example, if you work for an overseas company whilst you're in the UK, there may not be any issues with that. You'd probably be able to transfer that to an Australian fund without any issue. If it's a QRUPS fund and it was in there pre 2017, or even post 2017, if it's already in a QRUPS fund, you can move that QRUPS fund to an Australian QRUPS fund without that 25% tax charge. I think that's what the question was asking, but again, we can absolutely work through it and provide specific advice on that.
Perfect. And the next question here is asking their current. This person's saying their current Australian super fund, which is employer set, is with Australian Retirement Trust. It's not recognised by HMRC. Do I have to set up a separate Australian QRUPS to be able to transfer my UK super? Yes, you do, is the short answer to that question. It's to look at the two options available currently in Australia. The next question, which Nick, I'll pass to yourself because you touched upon this during the webinar. If you had an amount which exceeds the 3 times of the annual ATO limits, could you A, transfer another tranche 3 years later? And if so, what taxes would be applicable? And B, have the remainder in the UK and buy an annuity, which is a regular income? And if so, would that be taxed here in Australia?
Yep. So every 3 years, your non-concessional limit will refresh if you've triggered what we call bring forward provision. So 3 years, you do your 360. It'll reset 3 years' time. You can do another 360. And for any of those with large funds, you can keep on doing that until you reach the balance here at 1.9 million. Once you get to 1.9 million, you can no longer make non-concessional contributions. However, there are ways that we can help reduce the balance, particularly if you're in retirement age, post preservation age. So that's the annual limits covered. Then the remainder, you could buy an annuity in the UK, but that income would be taxed or assessable in Australia for tax purposes. So depending on how much the annuity payment was, depending on what other income you have in Australia, it would be taxed accordingly in line with Australian marginal tax rates. Yes, so I think that answers that.
Thanks, Nick. A couple here I'll just quickly rattle through. So if I take the 25% lump sum in the UK and later move to Australia, can the Australian government tax this lump sum retrospectively? No, it's only taxed based on the jurisdiction you're living in at that point in time in which you receive that payment, that 25% payment. So they won't look at that retrospectively. If you do receive it while you're an Australian tax resident, then that would change my answer, and it would potentially be subject to tax here in Australia. The next one, once accessing UK super, if I'm still employed, will my employer continue to pay super? So just to be clear, I'm assuming you're asking, are you working here in Australia and receiving a UK pension? Then yes, you can receive a UK pension paid to you, and your employer here will still continue to pay to your Australian super in addition to that. Then what it just means is that that UK pension is going to be added to your worldwide taxable income and on top of what your taxable income is that you're receiving from that employment you hold here in Australia. Now, the next question is, if you were to take the 25% tax-free from a UK fund and retain the UK pension in the UK, could you draw down on it periodically tax-free in Australia, or would each drawdown be subject to marginal rates? So yes, you would be subject to marginal tax rates on that income that you then draw down after you've taken that lump sum. It would be added to your worldwide taxable income here in Australia moving forward. Of course, if you kept that within your personal tax-free allowance, then of course it's subject to a marginal tax rate of 0%. But it will be added to your assessable income. And it's also important to note that that 25% tax-free lump sum is only tax-free in the UK. It is not tax-free here in Australia and may face tax here in Australia if you are an Australian tax resident. The next question is, are UK teachers' pensions one of those that are unfunded? Yes, they are, I'm afraid. Hold on, so I'm just scrolling down. How long does a transfer usually take? Ballpark, question mark. Nick, I'll let you define how long's a piece of string.
Yeah, that's a tough one to answer. Typically, defined contribution schemes or money purchase schemes will be a bit quicker, but there are a lot of requirements to fulfill. So firstly, we've got to get the information from the schemes, that's defined benefit schemes or defined contribution schemes, and that can take a long time depending on the providers that you have pensions with. Some providers will get it back to us in a couple of weeks, some will be a couple of months. They'll only answer half the questions that we need, then we've got to go back. So getting to writing the report stage typically for most schemes is 2 to 3 months. That then we can get that report written, presented to you. If you then decide you want to proceed with the transfer, if the recommendation is to do so, again, depending on each scheme, some will fly through and go through in a couple of weeks. Some will take 6 to 9 months. I've had cases that have gone on in excess of a year, which shouldn't happen, but very, very occasionally it does. So as an average benchmark, I would say you're looking from point of engagement to the money coming over, 6 months if the earliest, but it could be pushed out to 9 to 12 months potentially. So it is a long drawn out process, and there are hoops you've got to jump through in the UK, making phone calls to potentially to existing provider and potentially to government agency called Money Helper that's been set up for the last couple of years. So look, most of it is because they're protecting individuals, making sure that they're not getting scammed and transferring it to the wrong place, or they're transferring and they don't know why they're transferring. But yes, there's a lot of red tape to cut through.
Okay, thanks, Nick. Someone's asked here, if turning 55 subsequently to arriving in Australia, does the growth tax apply from 55 or arrival date, or a pro rata even? Unfortunately, it is from your arrival date, not from when you become able to bring that fund across to Australia. The next question, Nick, this client has asked, do the UK pensions have the total and permanent disability insurance rolled in like the Australian Super used to before you had to opt in to continue?
But very old pension schemes in the UK used to have an element of insurance, but no, there won't be any.
Perfect. The next question, why can you not transfer an army pension? I know many ex-UK army personnel that are transferring their monthly pension. If they're transferring their monthly pension, that means they're receiving their income from that unfunded defined benefit pension. It's being paid, whether that's paid to a UK bank account or Australian bank account, they're making that nomination. So they are able to transfer the money physically when they receive the income across to Australia. But what we're referring to is you cannot ask for a capital valuation and then look at transferring that as a capital amount across to Australia with a army pension, again, because unfortunately it is an unfunded government-backed pension. I hope that clarifies that for you on that question. Nick, I worked in the UK previously, then I re-entered the UK after some years with the same national insurance number. The NHS cannot find my previous employment as this was pre their computer database. How do I get HMRC to validate my cumulative 10 plus years of working in the UK for justifying access to the state pension?
Interesting. It's going to be a bit of a challenge. I know the NHS record keeping from years ago is not particularly great. Have you got any old pay slips that you can dig out and potentially use that? But I would be being firmer with the NHS pension scheme and insisting that they will have a record somewhere. It's probably an archive, but I would be going back to the NHS and pushing it to them, because not only your national insurance contributions, but you'll also have been entitled to an NHS pension. So, yeah, I would be going back to them and pushing as hard as you could to get that resolved.
Thanks for that, Nick. The next question here is, after accessing my UK pension and I took a 25% lump sum to pay off a UK mortgage partially, is there a time limit as to how quickly you may spend down the remaining 75% to pay off the remaining UK mortgage before then moving to Oz and triggering access to Australian superannuation funds? So in terms of the time limit to then access the funds, once you've withdrawn the 25% PCLS, there is no time limit other than the time of your life, as not to sound too facetious there in that response. But yeah, there is no time limit. You can obviously draw those funds as and when you wish. And what's important to note is that when you do make those withdrawals are going to be subject to tax, depending upon whether you're a UK tax resident or an Australian tax resident. If you are, that's going to be subject to your marginal rate in the respective country in which you are, of course, a tax resident. And then if you're then looking to trigger access to Australian superannuation funds, then that's related to meeting conditions of release here in Australia. So 60 and no longer working, or full condition of release also is when you reach 65 under current legislation. The next question, Nick, was one we come across quite a bit. I'm a UK freelancer with lots of pots of pensions. And what's the best way to compile them into one fund, and what does the fund need to comply with?
If you're, depending on your age, if you're under 55, it could be sensible to transfer them all into one pot in the UK, either with one of the existing pension schemes, or if you want that ability to be able to buy and invest in Australian dollars, then into a SIP. If you're over 55, you might be able to move them directly from where they are into an Australian QROPS without having to do that middle jump, but that is going to depend on what the value of those funds are, and whether or not it's going to be in excess of the non-concessional contribution limit. So in summary, you can consolidate in the UK, whether you're over 55 or under 55. If you're over 55, you can then transfer that over to Australia from the consolidated pot, or each of those individual pension funds, you can move them directly from the UK fund to an Australian fund.
Perfect. And the next question is, so the idea of hedging your bets on exchange rate is unrealistic. This might be a follow-up from my previous answer. I guess what I would say on the exchange rate point of view is, as a business, we have a business view that when you are in a position to potentially remove that exchange rate risk, we believe it is in your best interest to look to do so. Obviously, at the end of the day, it is ultimately your decision as to when you convert your funds, whether that be within the UK or within the QROPs here in Australia, if obviously that's the way we've proceeded. But of course, we'll have those discussions with you throughout. So, we'll let you know when that is, an option to then look at converting those funds accordingly, and ultimately, take your lead in terms of what your preference is in that respect. The next question is it possible to time a transfer so that it occurs in the desired UK and Australian tax years, i.e. after I've actually stopped earning income? So yes, you can look to, effectively transfer the funds when you have stopped earning income as such. There's going to be a few factors to consider there, because it might be that you can pay the applicable fund earnings tax that we've spoken about within the superannuation, and that may be a more beneficial avenue for yourself, paying that at the concessional rate of tax of 15% within that super, rather than paying it at your marginal rate, even if you are no longer working, because it will depend upon how much growth element there is in your UK pension transfer. Of course, if there is an opportunity to reduce that and potentially do so after you've stopped earning income, we can look at the pros and cons of doing that once we have a greater idea around what the growth element is within your respective pension. So it is a possibility, but obviously it's going to be specific to the exact situation at that point in time. So I'm guessing this comment again is following on from my exchange rate considerations. That transfer and exchange rate will be dependent on the time of transfer. Again, the exchange rate will constantly move throughout. We're fully aware of that. It's just a matter of just liaising with yourselves throughout, and making sure that as we go through the process and we get to the point of being able to start preparing forms for a transfer, of course, should we have recommended it, then we can have that discussion with yourself and go, right, given where the rate's sat today, are your intentions to transfer that in GBP or transfer that in Australian dollars, depending on where that's sat? Obviously, we'll ask you those questions as well early on in the process, so that we have an understanding of, if you have a target rate, are you going to, we know that at that stage, if the rate's above or below that, you're not going to want to exchange, or we'll look to exchange. And vice versa, if you're someone that's happy to just remove that risk ASAP, then we'll work on the presumption, we'll look to move to dollars. But again, it's always confirming that with yourselves throughout that process. So there's a couple of questions that have come in around fees. So I would suggest that if you do have a query around fees, let's have that as a one-to-one conversation, because those fees are going to be, again, situation specific to you as an individual, depending upon the number of funds you're holding in the UK, and potentially the strategy that we'll be looking to implement with yourself. And we can give you a clear indication with those initial discussions around what the fees are involved with the process. We're, as a business, we are very transparent with our fees from the initial consultation we'll hold with yourselves, so you are fully aware of what those fees would look like from beginning to end. And then we can obviously formalise that through our engagement documents, should you wish to proceed with engaging us to look into that completely. Again, regarding sort of product questions as well around what's the specific QROPs. Again, that's something we can have that discussion with yourselves offline. If someone wants to make an inquiry, we can again have that initial consultation and deliver a bit more detail around exactly who those potential products are, and obviously when's the right opportunity to potentially look at using those particular products that are QROPs and available to us to explore for your potential transfers. Look, I think we've pretty much gone through all the questions there. So if anyone has any last minute questions for our final 1 minute of our hour, happy to receive those in the next 20 seconds if you can type that fast. Otherwise, we'll take that as an opportunity to sort of thank you all for attending today's webinar. I'll just hold on, I'll share you the details of where our offices are located around Australia and the UK. And like I said, at the bottom of there, you can see our inquiries email address if you do wish to get the ball rolling and engage ourselves and explore the possibility of transferring your UK pension. As I mentioned, that email address is the best way to get in contact with us. Alternatively, you can contact us on the contact numbers in both the UK and Australia. Speak to someone and we can look to arrange a meeting from there, or take your details on the phone if that's easier for yourselves. But the clock has just struck on the hour. So in that note, thank you all for attending today's meeting. This webinar has been recorded and will go out on our YouTube channel, I believe, Nick.
Be on there.
Perfect.
I'm not sure.
And we'll most likely, so you will have the opportunity to watch it back if you've enjoyed it that much and want to listen to myself and Nick again. Otherwise, I'll bid you all a good day. Thank you very much for your time, and we look forward to hearing from you in due course.
Thank you. Bye.